Well, good afternoon and welcome to our High Rock Weekly Client Webinar. If you want to skip over any part of this webcast, feel free to use the fast forward control on your screen. Otherwise, sit back and enjoy. Each week on this call, we talk about what we see developing in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. I'm Scott Tomlinson, and joining me on the call today is my partner and colleague, Paul Tepsich, the founder of High Rock. Our certified financial planning professional, wealth forecast specialist, Bianca Tomlinson, has taken a short leave following the birth of her first child. She does, however, remain on call to us for her expert advice should we need it on your behalf. Well, each week we record this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener or would like a little more information about our private client services and our disciplined investing strategy, we do have a separate introductory webinar that will provide you with this. And all you need to do is visit the homepage on our website and click on the Introduction to High Rock Private Client button. While you're at it, you may be interested in our voluntary code of conduct as well, something that takes us well above the regulatory requirements in many ways and highlights how we always put our clients' interests before our own. As we mentioned last week, but think is pretty important, in the June edition of the Small Investors Protection Association monthly newsletter, High Rock was singled out and recognized for our leadership role in the investment industry as a new breed, where fiduciary responsibility and the client's interests are our first priority. We think that this is a really important part of the conversation surrounding wealth management. At High Rock, we do not have shareholders to answer to. We do not have revenue targets to meet. We do have our own money invested in the exact same assets as our clients, so we will do for you what we want to do for ourselves, and that's grow our money, but always with an eye to managing the risk first. And we may not always perform with the stock markets all the time, especially if we deem that there is too much risk inherent in doing so. We will elaborate a little bit more on that and on risk in a moment. But first, we're going to talk a little bit about fees and fee transparency. Now, Paul wrote a blog on fees this morning based on a Globe and Mail article that he came across. So let's bring Paul into the conversation now.
Hey, Scott. The article was a Rob Carrick article on the ROB this morning, and as you said, I wrote a blog on it. People can read that and certainly read the article, but effectively it was a female writer by the sounds of it, or a reader and writer, into Rob, basically saying every time we go to talk to our advisor about fees, they say it's too complicated and we can't explain it to you, and we find that just a bad excuse, quite frankly, and if I was a client and somebody said that to me, I'd feel like they're hiding something. So I just wanted to highlight our High Rock private client fee structure, and it's pretty simple, and an infographic, as you can see on the screen, is the best way of doing it. We charge 1.15, and that includes the Raymond James custodial fee that we need to pay out of there, which is about 12 basis points, and about 3 basis points of trade costs and expenses and fees when we trade securities. And High Rock keeps 1.0% as our management fee, our net management fee, and that's so, as I said, we can buy bread and wine. And then we do use some third-party managers. In our case, we use some very low-cost ETF securities or units so that we can get exposure to different geographies and asset classes that we can't actually do directly. Most of the investing we do at High Rock is direct because we are an asset management firm, but there are certain geographies and asset classes we just can't get exposure to, like Asia. We're not going to go buy stocks in Asia or Europe or emerging markets. But as you can see, that only adds about 0.05%, which I would consider de minimis to our overall fee structure. So our clients in green pay 1.20, and that includes all those hidden or embedded fees, which, quite frankly, the Ontario Securities Commission doesn't force advisors to divulge as well as they should. I hope that explains it.
Sorry, Paul, but that brings up an interesting point too, because we don't have a full portfolio of even of ETFs, let alone having third-party mutual funds. But those MERs on the ETFs, they can actually add up significantly if they're 100% ETF portfolios, right? And one of the things that is really important to remember is that our fees are tax deductible, but the management expense ratios, or MERs, in those ETFs or any other mutual fund, you don't get the ability to expense those. So I think that's a pretty important case.
Yeah, for sure it is. The ability to deduct on your tax form the fees that you're paying, the 1.15, and you're getting an asset management firm that's managing more of your assets in-house. Absolutely.
Yeah, and I think that's a pretty important part and part of the conversation that one should have. And if you're not a client and you're happening to be listening in, it's worth having a conversation with whoever is looking after you to make sure that you're getting absolute transparency at all times.
Scott, you should add though that you can't deduct our fee, our 1.15%, from a registered account though, right? Just cash accounts or non-registered accounts.
True, but in an RSP, it is considered a tax-free withdrawal when you do pay that fee. So you're actually being able to withdraw money from your RSP to pay the fee without any tax implications.
Right.
But in a TFSA, you're absolutely right. There's no benefit from a tax perspective there. But again, in a TFSA, you're not paying any tax on any of the growth of the investment. So it's still a very beneficial account to utilize. Well, last week we showed this chart and we talked about risk, and we often talk about risk. And I did get some client feedback asking us to explain this in just a little bit more depth. So here you go. As we always point out, we manage risk first. And basically what that entails is that we have to make a determination as to what constitutes reasonable risk to get a decent return on any particular investment. If we see growth potential, much of the risk gauge that we use has to do with volatility. So we do a great deal of work researching the historical volatility of a particular investment to determine the potential for risk. Now, generally, we want to know what has been the price reaction or volatility for a specific asset to any particular amount of market turbulence. How far can the price of the security move from its average price? And this is how we can assess the potential for risk into the future. When we look back at all of the investments in a client account on a cumulative basis, we can tell the amount of risk that has been taken and make a comparison to a certain benchmark. In this instance, we use a combination of 60% of the All Country World Equity Index ETF, or ACWI, and 40% of the Canadian Bond Index ETF, XBB, as the benchmark. Now, as you can see, the benchmark combination gives you 4.6 units of risk, while the HIROC client is only taking a little less than 3 units of risk. So in fact, taking less risk is not a bad thing. Now let's look a little further along. On a relative basis, over the last 4 years, the average annual return of the benchmark is a little over 7%. Whoops. Divided by that risk factor of 4.6, that gives us a return per unit of risk taken of 1.6. Now, the HIROC client over the very same period has a comparative average annual return of almost 9%. And with a lower risk factor of just a little over 3, gives us a return per unit of risk of around 3. Now that's significantly better than the benchmark. So I hope that this is a reasonably clear explanation But of course, we would certainly be happy to discuss this in greater detail with any of our clients or anyone who is listening who is interested for that matter. Paul, do you have anything that you want to add in this?
I guess maybe if you go back one chart and go to that sort of bell graph on standard deviations, we could, maybe just have people look at that chart for a second and just see that effectively what the standard deviation does, a measure of variance or volatility in your average returns. So basically you're looking at one standard deviation from the average return. So if your average return is 7% and you're only one standard deviation from that, you're not varying, or your risk of varying too far away from that average or average return is lower. If it's 2 standard deviations in green or 3 standard deviations in red, you can see that you would be that much further from your average price, or pardon me, your average return over that period of time. So that's when we talk about standard deviations being a measure of risk. It's how, over time, how far you're going to deviate from your average returns. And we want to deviate the least amount possible. We want to be as close to that average return as we possibly can.
Great, thanks for that input. And again, as I said, if anybody does want to chat about this in a little more detail, we're certainly happy to do that. Well, by now you all know our key themes for this year. Certainly one of them is avoiding risk when risk is high, and that means being more tactical inside an investment portfolio. Price stability is a mandate for all central banks, and the level of inflation or expected inflation is a key determinant for central bank policy. Now, the Bank of Canada raised rates a couple of weeks ago. The Bank of England and the European Central Bank have dropped hints that they're continuing to monitor their easier monetary policy situation and ready to begin the process of reversing it when it is suitable. We know the U.S. Federal Reserve has raised rates by 0.75% since December, and is now expected that they may only raise them again in December of 2017. So one more quarter point increase this year. But rising borrowing costs and reduced financial system liquidity could very well increase volatility as we move forward. Stock prices and valuations are at close to their highs, but without more significant earnings growth, this leaves them vulnerable to correction, we believe. Economic growth does not appear to be supporting current valuations. And the Trump agenda has so far failed to bring a new healthcare option and impeded progress on fiscal stimulus. Brexit negotiations and NAFTA renegotiation, tensions with North Korea, Russia, and the Middle East, as well as global cyber attacks and terrorist threats all add to the blend of political uncertainty that confronts us on an ongoing basis. So having a more tactical approach to investing allows us to not have to depend on the less reliable old correlations, which do not appear to be providing the appropriate balance as they have historically in the past. And we remind everyone listening that historical returns are no guarantee of future returns, but at High Rock, we do work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is very important that we review your wealth forecast on a regular basis with you so that we can ensure that your long-term goals are still in line with your portfolio strategy and that our forecasts for your net worth into the future are up to date and heading in the right direction. If you would like to review any aspect of your portfolio or wealth forecast, please do not hesitate to reach out to us. Well, the evolving inflation story, one of our themes for 2017, is that we want to try to assess the implications for central bank monetary policy and interest rates. If economies are growing, inflation should be growing, but this does not necessarily appear to be the case at this particular moment. Now, the Bank of Canada, as I said, raised interest rates by a quarter 2 weeks ago, but inflation data remains benign, and the most recent data came in showing CPI at 1%, and now that's well below the Bank of Canada's target. They expect that in the context of an economy that is approaching full capacity, inflation is expected to reach the 2% target within the next year. But remember, the Bank of Canada economic forecasting has been less than accurate in the past, mostly erring to the positive and therefore underachieving. The European Central Bank stated last week that while ongoing economic expansion provides confidence that inflation will gradually head to levels in line with their inflation aim, it has yet to translate into stronger inflation dynamics. And the Bank of Japan lowered their inflation targets, not expecting to get close to the 2% level until 2019. And meanwhile, as we reach the end of the second quarter's group of economic data, U.S. GDP forecasts continue to run at levels well below earlier expectations. The U.S. Federal Reserve is meeting today and tomorrow and will announce their latest decision on interest rates tomorrow. No change is expected, but we will be watching for any hints of future policy in their statement to the public. Well, with the Bank of Canada changing its course on interest rates, traders and speculators were caught off guard, and those who had the trade long U.S. dollars and short Canadian dollars had to scramble to cover those positions, driving the U.S. dollar lower and the Canadian dollar higher. This is almost a 9% move, and it's going to have an impact on the Canadian economy as close to a 3% increase in interest rates. And that is significant, and that will certainly impact exports and certainly the tourism part of the economy. Paul, do you have any comments on what you think about the Canadian dollar? I know we've had some discussions about, is it time maybe perhaps to make some purchases?
Well, that's something we're certainly looking at, and I think you phrased it pretty well. Effectively, the Bank of Canada has two levers, or any central bank, two levers to affect monetary policy conditions. And one of them is the currency, and as you can see, the Canadian dollar has strengthened up, as Scott said, 9% over a very short period of time, like 2 months, which is very hard for a lot of exporters to adjust that's less than a quarter, one significant one calendar quarter, and it's incredibly hard for these exporters to adjust their business model in 2 months' time, like within a quarter. And the other way they affect monetary policy is through short-term interest rates. So both those levers have tightened up monetary conditions enormously on the Canadian economy right now. As far as actually buying U.S. dollars and selling Canadian dollars, we're looking at that very closely right now and looking to add some U.S. dollars, and we're just trying to fine tune our entry point for some of our listeners who may be looking at buying small amounts of U.S. dollars for snowbirds, etc. People traveling this summer, certainly this has helped out some of us Canadians who may be traveling abroad, and probably not a bad time around this 125 level to go buy your U.S. dollars or any other of your foreign currencies where you may be traveling to.
And I'd like to bring up a point here too, and I've had this conversation with a few clients over the course of the last few days, in fact, that interestingly, and I wrote a blog on this the other day, but if you do have Canadian dollar needs, or sorry, US dollar needs, we always have US dollar assets in your portfolios. And one of the things that we have the ability to do is to continue to purchase US dollars at a wholesale rate. And that can be significantly better than the rate that Canadian banks will charge. Because Canadian banks make lots of money taking a spread. Now, they will claim they don't take any fees, and that's very likely, but they do take a spread between what we'll call the wholesale rate and the rate that they will sell US dollars to unsuspecting tourists and people who will head south of the border at any point in time in the year. So we have a few clients who are spend winters in Florida and other parts of the U.S. and we do constantly have U.S. dollars in your portfolio. So one of the very, very easy things to do is to have a U.S. dollar bank account and even a U.S. dollar credit card, so you don't have to worry about conversions at any particular point in time. Paul and I are watching this for you in your portfolio, and if you need US dollars, we're always there's always an availability for us to go and get those.
Sky, I think now is a good time, and I know you wrote a blog on this 3 months ago maybe, but just let our listeners know that we do have clients who wanted to purchase a house in Florida, and correct me if I'm wrong, but rough numbers, they wanted to sell about $350,000 worth of Canadian to buy US dollars to buy this place in Florida. And we actually did the FX transaction for them at the wholesale rate, which means like right on the screws at where the banks trade foreign currencies with each other. And we saved our client roughly $12,000.
Yep, that's about right.
Bank showed them.
Yep.
Now, if you went through an investment advisor or a personal banker, they would have kept that 12 grand in their pocket, but our clients kept it in theirs.
Yeah, I think that's a great point. As regular listeners will know, we've been paying close attention to the global debt situation and borrowers' ability to service that debt as interest rates move higher. Obviously, that becomes a bigger issue, and global debt levels are currently at record levels. And of course, you all know, we think stocks, especially US stocks, are expensive. Earnings are expected to grow at a rate of about 6.5% over the course of the next year, where stocks have already built in at 27% rate of growth over the 10-year average. So something doesn't quite fit. So that makes us a little bit somewhat concerned. And as they say each week, the enterprise value to EBITDA is expensive as it was at the time of the dot-com bubble. And then we turn to the geopolitical front. The Trump administration continues to struggle to move its agenda forward. And in its latest report, the International Monetary Fund said that U.S. growth projections are now being revised lower than they were in April, which primarily reflects the assumption that fiscal policy will be less expansionary going forward than previously anticipated. Paul, any thoughts that you might have with regards to what you see happening south of the border with all of this situation going on?
Well, yeah, I mean, just in general, I think economic growth is slowing for sure. And that's been happening over the last number of months. The Federal Reserve, which you mentioned is meeting today for tomorrow at 2 p.m., is highly unlikely to raise rates. I think, if at all, they raise one more time in December. But I think they're responding in some of their speeches with a bit more of a dovish, which is less likely to raise rates type comments, so more dovish comments. And then the third thing is on the fiscal front, certainly seems like President Trump's administration is unable to get a lot of things done through Congress. And I think the only remote positive you could read from the fiscal situation in the U.S. is that even if he doesn't get things done, it's still the fact that there won't be further regulations put on business. It's still a pro-business environment. But that's about the only possible positive you could see out of what's going on in Washington right now.
All right, thank you. So here we are at High Rock. We want to continue to get portfolio growth, but of course, as I've mentioned, we're somewhat uncomfortable with equity market risk at the current levels. We think the U.S. economic cycle is in its late stages, and there's signs that do make us uncomfortable with having too much risk in our models and our portfolio. So we've all worked very hard for our money, and we all want to make sure that we invest it prudently. And as I say, I've been saying each week, we are stewards of wealth. We are not gamblers, and we don't believe that the risk is to a large degree, the risk is worth it right now. Paul, any updates on your thoughts as far as the tactical model is concerned?
Yeah, in tactical, we actually had a interesting day when we walked in this morning. Our largest equity position in the tactical model, or I guess in our portfolios, which is AGT. It used to be called the Alliance Grain Traders. It's now called AGT Food and Ingredients, and basically this company it's a Canadian company, and they process and ship lentils and peas and all those sort of items that are called pulses all around the globe. Anyway, we woke up this morning to hear that they did a $190 million preferred share deal with Fairfax. So this is seen as very positive for the entire capital structure of AGT. Now, it was our largest equity holding. The stock at one point was up about 10% on the day. I think it ended up around up 5.5%. So it did give up a little bit of ground, but we also own the bond in our fixed income portfolio, AGT high yield bond, and that bond was up around 1.5% as well. So this is definitely seen as a positive outcome. I did have a conversation with the CEO of AGT this afternoon. He gave me a call and explained his reasoning for doing this transaction with Fairfax. So the stock closed around 27.25. It got down as low as 21 and change. We ended up buying some June 30th, so about 3 weeks ago. We added to our position to make it our largest position at $23.01. I mean, this is easily a $35 stock again, and I think the fact Fairfax is involved and with a board seat, they're going to get there. So that was sort of one piece of news, and really away from that, we're just picking away at a couple items with some newer clients. Yeah, I think that's about it, Scott, for the entire portfolio.
Okay, well, that's great. Great news on AGT, though. All right. Well, as always, we want to thank you all for taking the time out of your busy schedules to tune in. I hope you like our somewhat new, more dialogue type format. And I have actually gotten some reasonably interesting feedback, good feedback after last week, and we started to change things up a little bit. And so if anybody else has feedback, any questions, anything that you want us to talk about, we're going to get a little bit more focused each week on certain issues. So we're very happy to bring up any topics of interest of any. And as I always say to our clients or anybody who wants to provide feedback, if you have a question, I'm sure there's at least another 20 to 25 questions of similar nature out there. So we really do want to hear from you if you've got something to say. In any event, we will certainly be back next Tuesday. But until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a wonderful rest of the week and a great weekend.